Welcome to the podcast. My name is Taylor Avakian. I'm here with my esteemed guest today, Daniel Mense. Danny, I got a hot one for you. How many units do you own, and what is your assets under management currently?
Well, it's great to be here. Thank you for having me. Cage Equities, my firm. We have about 1,000 units, roughly valued at 300 million, here in California and the Carolinas.
And what proportion of you are you in Carolinas versus California?
It's about 50-50.
Really?
Yeah.
When did I?
Surprised you, huh?
I didn't know that because you were. I mean, I know you were going out there. That started a couple years ago, 4 or 5.
2021.
21 is when you started to go buy out of state. And I assume that was because, one, you're an opportunistic entrepreneur and you saw the writing on the wall or an opportunity there. But was there any sort of hesitancy with what's happening with Los Angeles and the regulations and things like that? Was it harder to get your business plan done?
For sure. Los Angeles, California definitely doesn't like to make it easy on landlords to do business. And capital too was just getting skittish about at least our capital being so heavily concentrated in California. They wanted some more diversity and kind of access to where all the growth is going, which between Sunbelt markets, the Southeast, you just saw a ton of migration out there. So, um, coupled with the fact that doing business out there is much easier, regulatory environments a lot more stable and easy to understand, demographic growth, all of that. It made sense to start diversifying out of California, and we started taking a heavy look in a number of markets in the Carolinas. Caught our attention beyond just the fact that they were good, strong growing markets, but because we're an affordable as well.
Mm-hmm.
The affordable regulatory environment out there is quite favorable for what we were looking to do. So that just, kind of confluence of factors made those markets prime for us.
For people who don't know, when you say that it's easier to just do business, right, or to manage the properties, what exactly is easier? What about the process is easier?
I'm like scared to answer this in fear of
No, I mean,
some council person in LA listening to me and
evictions,
blackballing me.
like, raising the rents, the regulations, like, I assume that's probably
So
what they are.
sure. So yeah, look, the biggest concern, right, investors, operators have with California is that the regulatory framework can change on a dime, right? And like that is what makes a market most difficult to invest in because it's impossible to underwrite. Like you cannot underwrite a rent freeze, right? You cannot underwrite an eviction moratorium,
Mm-hmm.
right? And that completely throws your underwriting on its head. So, you know, taking it to the other side, when you look at markets like Texas or Florida, Carolinas that are more business friendly, one, aside from having a lower cost of doing business,
Mm-hmm.
from our perspective as Californians, business friendly also means just it's a much more stable environment from a regulatory and legal perspective, right? Like we know what we're getting into, and the way the legislatures ran out there, there's just typically very little variances in new laws being passed,
Got it.
right? Um, so the outlook on how you're going to run your property largely is consistent with where you are today. Of course, things are changing, and they may put new laws into place that can create some degree of difficulty, but by and large, you kind of know what you're getting into.
Mm-hmm.
And then obviously coupled with the fact that you're not just taxed up the wazoo on every little thing that you do, also just in that and of itself. Um, Creates just a more pro-business environment. Now, obviously, on some level, that still gets priced into the deal.
Sure.
So, how much benefit you're getting from it, um, it's you're kind of paying for it in another way if a place is more pro-business. But for the most part, right, when I refer to pro-business, business friendly, it's just the regulatory environment is a lot more stable.
Mm-hmm.
And generally speaking, I would say these markets are, I'll venture to say, like, respect property rights, right? So if you own a property, like, you own the property. You're not beholden to some greater authority who decides how your property should be ran and what's fair and what's not,
Mm-hmm.
right? Um,
And that makes it a lot easier to have a business plan. And honestly, for you, because you're a real estate private equity firm, technically, I believe, you have investors. And so if they're going to invest their money with you, they want to feel confident that you feel confident in the business plan and can go and execute on that business plan. And so it sounds like the ability for you to have less unknowns or uncertainties, coupled with the fact that those markets are growing, and your experience here in Los Angeles, that it kind of leads you to a no duh, and at least let's try this out and figure out if it's a good fit. I know a lot of investors, and you probably know the same people, who went to Texas, and Texas kind of kicked their ass a little bit. I think there were a lot of uncertainties and unknowns that they were not expecting from a typical California property. Property taxes, being one, a big one. Utilities expenses are 50, 60, 70% sometimes in those buildings. What is the typical, I assume value add, but give me the, like, you buy a building for, I don't know, 100 a door. How much do you put into the units, and what is the increase in the rents that you typically see in North Carolina?
So looking out there, you buy something. I mean, we're typically going to spend, let's say, anywhere between 8 to 15,000 a door.
Okay.
For like the last asset we bought, we paid around 130 a door.
And 8 to 15, how much does that cost in LA for the same level of reno?
Like 300,000.
With the buyouts included.
Yeah.
Like 30? Like double?
Yeah, I would say, it's a 2x. Again, I mean, the properties in the Carolinas, those are those are affordable properties. So
Capital A or lowercase a?
lowercase a.
Okay.
So, buying market rate, converting them to affordable, and qualifying for various state incentives. So,
Is that like Section 8 or?
no. I mean, we have a lot of Section 8 renters, but
Sure.
typically we have to rent the units to people who make a certain AMI or less.
Got it. And you get
those are the
incentives or tax benefits or something.
basically.
Got it.
And you get also, favorable financing, and that's kind of how you kind of engineer these deals to make sense. But we're gonna spend, call it 8 to 15,000 a door on doing renovations. I would say you're not going to the, like, let's just say if it costs double to do it in LA, it's not like for like, right? We're not going as far, because Los Angeles, I mean, you probably see just a bigger pop.
Yeah.
I mean, your rents are just higher.
Yeah.
So, it naturally will mean, I mean, you could spend more dollars and it be justified. Out there, I mean, we're seeing great rent growth, but yeah, around, we're going to spend 8 to 15, and we're looking for, at least a 20-25% pop on our rent
Okay.
to go spend that.
Okay.
Um,
And that's pretty consistent. Like there's not the vacancy rate, the time on market. I know California people, we have a housing shortage, and I think the average vacancy right now is somewhere in the 95 to 95.5% occupancy rate. So 4.5, 5% vacancy. In the Carolinas, are you similarly, or is it 92, 91?
I would say, I mean, 30,000-foot view, hard for me to say. Our markets, we're more predominantly like workforce
Got it.
oriented markets. We're pushing our rents a little bit, still staying in line with like the affordable
Yeah.
covenants.
Of course.
But, we're now seeing, I mean, look, we're not so far off. Let's say 93-94% occupancy.
Okay.
And we're, again, we're pushing on our rents. And there's some more, there's aspects of the fact of what we do, because we are looking for a specific demographic to have to rent. They need to be a certain AMI. It sometimes can be a little bit more, take a little bit more time to find the right renter or find the renter that qualifies. Um, but
Overall, it's pretty
yeah,
good.
it's been holding up pretty well. We haven't really felt the brunt just because of the asset class that we're in, which is
Mm-hmm.
more like Class B, C,
Mm-hmm.
of all the new supply coming online, right? Which there you've seen a big uptick in vacancies, rent concessions, and so forth. You just had so much Class A products coming online, which, I mean, obviously is going to put downward pressure on existing Class A, but because our rents are so far below, I mean, typically we want to see, I would say, a minimum of a 20% discount to Class A rents, if not, 30, 40%.
Got it.
We're not going to really feel the impact of all that Class
Yeah.
A product coming online. So, I'd say what is a little trickier, at least specifically with the buildings we have, is bad debt, right? It's even though it's much easier to evict tenants,
Mm-hmm.
right, in markets other than California. We still, you are carrying a higher level of bad debt
Got it.
than what I'm seeing on our properties in California.
Got it. And you have a very interesting background in terms of how you got into the business and what you did before. You have this financial engineering, corporate finance background, I guess you could say, which probably affects the way that you look at deals, how you get creative with deals, how you structure them with equity and debt and all that fun stuff. Can you tell me a little bit about that background and then how that's portrayed itself and how you approach deals in your investing?
Sure. So I was working in financial advisory over at KPMG prior to getting into real estate.
So you're a nerd.
Uh,
I'm just kidding, brother.
you want to call me that?
No. You're good with numbers.
Yeah, comfortable with numbers. So I was doing valuations over there, a little bit of consulting, um, just doing tons of underwriting on various various companies across a wide variety of industries. Um, so real estate was not like an industry that I had any particular affinity for, or family was in it. It just was an opportunity that came along that I jumped into at the right time in 2012. Um, but just having a degree of comfort with numbers, um, outside of just kind of doing your traditional value add multifamily, which, for all the love that I have for the space is super, super basic. It's a very, simple, mathematically to understand value add multifamily is like, if you have, the math level of fourth grader, you can do value add multifamily.
Yes.
Um, what I liked about where I kind of shifted, when I started shifting away kind of from value add multifamily, because in my opinion, it's largely commoditized, right? And the difference between one operator to the next in terms of execution, I mean, you can go online, and again, this is not to like knock anybody, and we do the same, and it was a great business for the last decade. Um, it's all the same, right? They just may use different adjectives for describing cabinets or what it is they want to
Yeah.
do, but it's all, it's the same. We won't say pig, but
Yeah.
but
Lipstick on the pig. It's the same playbook.
yeah, right.
Do this, do this, do this,
It really just
NOI.
comes down to who has access, right, to capital at the right time, and who sees the deal first at the right price. Right?
Relationships and it's relationships.
That's what separates a successful operator from a not someone who's not necessarily being that active. What I liked about, when I started to kind of look, I would say around like 17, 18, um, when I went off on my own, started looking at other spaces within multifamily of where I can kind of utilize my financial background to give myself some sort of edge in the marketplace, beyond just hitting the phones and trying to get a deal before the next operator gets the deal. And, affordable housing, capital A, was where I started to look, because it's a bit more esoteric of an industry, right?
Mhm.
Like a lot of affordable housing comes down to how you structure the financing, right? And then understanding tax code and so forth. Not that I really get the tax code side of things, but there's more barriers to entry. I mean, just anecdotally, I can tell you when we used to compete on properties here in LA, I knew it was time to start looking at another space when I was competing against, soccer moms, and soccer moms are great, but I would,
Yeah.
question, whether or not they should be buying
Yeah.
multifamily buildings and doing this. And, they were also, I mean, when we were selling properties, we're selling it to people that clearly, had this was like their first foray into the industry. And as a seller, it's like you love nothing more
Of
than
course.
that.
Yeah.
But like you look at that and you're like, huh, maybe
Yeah,
there's
this
a
is a
problem
sign.
here. And so I started kind of, looking elsewhere where I can still kind of, uh, use the industry knowledge I have within multifamily, but kind of coupling that with my financial background to, you know, go start looking at deals in a different light other than just like, great, I'm gonna, slap in my shaker cabinets, granite countertops and be like, I'm a genius, or
Yeah.
like, look what I can do. So that's kind of where I started pivoting and looking more into the affordable housing space.
Can you define capital A versus lowercase a? I know it's a term that everyone uses, but
Sure. So I mean, capital A affordable is what we all know as like low income housing tax credit deals, like
LIHTC.
right? Um, which basically are apartment buildings that get financed using tax credits and other public subsidies to go build. And then that'll, oftentimes that would also these properties come with project-based vouchers, which are basically having Section 8 vouchers attached to the property rather than looking for individual people who have Section 8 vouchers, but that's attached to the tenant,
Mm,
right? So it's like the coveted, you know, holy grail of affordable housing to get project-based vouchers. And I mean, within that space, it also breaks down to different types of contracts. But by and large, when you have a project-based voucher attached to a property, it's basically like an ATM. It's just a money printing machine. So
why?
because it's basically the government guarantees you the rent, right? And all you need. So typically, if you're renting to a Section 8 tenant,
Mhm.
right? What happens is you put your unit up for lease and someone, comes and says, I want your unit. And they say, I have a Section 8 voucher with me. And, normally those Section 8 vouchers track with market rents, right? And the tenant pays a very small proportion of the overall rent. So, you're getting most of your income paid by the government, right? The tenant covers a very small proportion. However, you can only get that to the extent that a tenant who has a Section 8 wants your unit, right? With a project-based voucher now, your building holds all the vouchers. So all you need are people who qualify at the right income levels to come in, and then your building basically gives them the voucher.
Got it.
Now there's just, just given the lack of supply, availability of units, how much income levels have grown by over the years. There's a lot of people that are qualifying that otherwise can't get still access to tenant-based vouchers because they're very competitive to get. But now they come to your building, you hold the vouchers. So you as long as, I mean, there's still a whole
Sure.
dance you got to go through with the tenant to make sure they comply. But once all of that's done, right, your building gives them the voucher and the government steps in and starts paying. So that's like what everybody's trying to get. And I mean, getting project-based vouchers. They call them PBVs,
Uh-huh.
right? For a building or buying them, it's just you're paying up for those.
Got it.
Um, so
And that's the level of security basically in the asset and knowing where your income is going to be, right? Because then you can calculate your NOI and feel confident at least in the numbers. And I know for LIHTC, because I underwrote a couple LIHTC deals, and LIHTC is such a niche, unique space because it's almost like this financial engineering situation where there's value in these vouchers and correct me if I'm wrong, but basically you have value in these tax credits that then you can sell to someone for, let's say, 90 cents on the dollar, right? And then they get the difference in what they pay versus what they can go use that which directly reduces their taxable income or their tax burden, right?
Yeah.
So instead of like having a write-off where you can take 30% off of the value of something, it's 100% on your taxes, like 100% write-off, essentially, right?
Yeah, I mean, look, in essence, a tax credit it's just like what it sounds like. So, like, a company like Google, right? It's just printing money. They want to shelter income. In theory, they can go buy these tax credits from an affordable housing developer. They'll give the developer money, however it layers into the capital stack, and then in exchange, they can now get this write-off, right? That money that they're giving to the developer effectively becomes a write-off on their books. I mean, it's a degree more complicated than that. In
Sure.
essence, it gives the tax credit investor,
Yeah.
right, a write-off, and it gives the affordable housing developer the capital to go build the project.
Got it. And this happens before they build the project.
Well, yeah, you need to secure like the full capital stack before you can start building. So, I mean, but that's, tax credits are layered in with recycled bonds, traditional financing, right? I mean, it's not a tax credit deal does not get financed with 100% tax credits.
Got it.
There's, 3-4 other stacks of capital that come in before it to finance the whole project.
Got it. And then once that's complete, right? Because my understanding was once that's complete, then it starts printing money because of the basis of it, or what aspect of it.
No, so definitely doesn't print money per se.
But
I mean,
you know what I mean? Why would someone want to do this?
it's specifically like a builder who's doing a tax credit deal largely is going to be looking at the fee. So, developers can take up to 20% of the project cost as a fee, right? Now, if you're building, $50 million project, you're taking a $10 million fee.
Wow.
Right. Now, that doesn't get all paid up front. There's mechanisms in there to ensure that, the developer performs, that the project performs before it gets paid out. But effectively, I mean, so long as you know what you're doing, right? And I mean, the big boys definitely know what they're doing. They understand the whole process, how to operate. Like you're all but guaranteed that fee, right?
Got it.
So, that's really where the incentive comes in for the developer.
Got it.
Majority, because these deals are so highly structured from a debt standpoint, there's virtually little like free cash flow that comes out. That cash flow is going every which way to pay off bonds to the lender. So as a developer, you're effectively seeing zero cash flow from the deal. Maybe you could be a property, take a property
Sure.
fee, see if you could work on it, some other fees along the way, but that's not where you make the vast majority of your money. Most of it is coming via these developer fees that you can bake in to the deal. And, it's not that you don't care how much a project costs, but on some level you want the project to cost more.
Yeah, it's like cost plus.
Because I mean, you're taking a percentage of it, and so long as it underwrites,
Yeah.
right, and pencils,
Yeah.
like you're like, fantastic. I'll take 20% of a larger number.
Yeah. Oh, that's so interesting.
That's how it's done. Now we look to buy, existing LIHTC projects.
Yeah.
And in those instances, that typically underwrites, or I would say like the process in which we're looking at a deal would closely follow that of like a market rate deal where, we're looking for upside. We're looking to see where if rents are, below the net max rents, which, is whatever is prescribed for that area of like what the affordable rent is.
And then you can increase the voucher limits. Is that how that works?
No. So vouchers are completely independent and separate from tax credits.
Got it.
You could buy a tax credit deal that has a project-based voucher with it, but you could also just buy a tax credit deal that's just, has, you're just renting to low-income tenants without any vouchers.
Got it.
So, buying an existing live tech deal, you're really looking, you're going to look at kind of your traditional metrics, your cash yield, your IRRs, your return on cost, and making sure all of that kind of
Mm.
aligns with whatever it is, whatever hurdles you need to be hitting, versus your tax credit, like ground up deals where it's like, okay, is the fee worth it for what, we're building here?
Got it. You are known for doing very interesting, creative projects, and one that we talked about previously was you had bought a $75 million deal with only $700,000 of equity. Can you please explain that to me?
Oh yeah. So, this was a project up in the Bay Area
Uh,
in Pacifica. So this was an existing market rate site, um, that our goal here was to convert to affordable.
okay.
So we had to go negotiate a regulatory agreement with the city to be approved to convert this to affordable. And then in doing so, what that effectively allowed us to do was um, qualify for property tax exemption, and as well as this like extremely highly structured financing deal that we put together. So um, once we had executed, we got the green light from the city that they were going to back us to um, convert this property from market rate to affordable, and in addition, we also were approved to build another 42 more units on the site. Um, we were able to we secured an institutional lender who's got, I mean, a number of these big banks out there have, their arms that are focused on like affordable lending.
Mm-hmm.
So they came on board with like 90 something percent, 92% of the total capital stack,
Okay.
which was structured out as like a senior, a B piece, some pref equity, and then we were able to secure Facebook, who brought in another 6-7% of the total capital, um, basically leaving us with a 1%, right,
Holy
down
crap.
payment. Um, and all of it's basically structured as debt.
Okay.
Um,
Why does that make sense, or how does that math make sense from you? Like, why would you do that deal?
I mean, I'll put it back on you. If I said you can own this property, right, you don't have to put any money into it. It's all non-recourse debt, right? So zero
Got it.
zero kind of
Got it.
recourse to you. Like, what's your downside?
Yeah, there really isn't.
Now, I'm gonna, first of all, I love my lenders on this and Facebook. They're awesome, and trust me,
Of course, we love you,
yeah,
Mark.
the
Thank you,
project's
Zux.
fantastic, and it's gonna do great. But look, at the end of the day, the fundamentals of a deal is ultimately what prevails here, right? It's not just, oh, because you're getting a ton of money, just go buy something and hope for the best.
Yeah.
We came into this with the first idea, with the premise of this is a good deal, right? Um, we found a lot of ways to add value here that the rest of the market just wasn't underwriting. Um, so
Was it on market, or was it?
it was, yeah, it was marketed.
So okay, that's what I wanted to dig into. So you saw an opportunity where others didn't, because when something's on market, a lot of people see it. That's my job as a broker, is to go and market and make everyone possibly who can see this or possibly buy this to buy it, right? That's my job. So this was not a secret. And were you having to compete on this, or did you see something where you said, okay, we can do this, this, and this, that only your specific knowledge, or primarily specific knowledge of being able to engineer it like that, that's what allowed you to win the deal and
Yeah.
feel confident in it?
Yeah, for sure. I mean, it was a heavy lift. I'm very happy we did the deal, but it was just not without its bumps and bruises along the way
Yeah.
to get it fully stabilized. Um, but yeah, I mean, the deal made sense at the pricing that we were at. simply because we had so many levers that we could pull to drive NOI beyond just the way the broker was marketing and the rest of the buyers were looking at it, right? I mean, it was just being marketed as a simple value add deal, go and push rents, and, the yields and everything really didn't make sense. Now we probably could have got a little bit of a better deal,
Yeah.
but nonetheless, even at our numbers, looking back on it, I would still do the deal 10 out of 10 times. And I wish I had, a bunch more deals like this, but
Is that debt like 10-year money? Because what I'm trying to figure out now is, okay, let's say you do all this stuff, you increase the NOI, you're still the GP, the owner on this, right? And there's a huge amount of debt. And so the way that you typically structure stuff with your investors, your LPs, is 80, 20, 75, 30, whatever. But you got to make sure that the debt gets paid off when that loan comes due.
Sure.
Was there something significant about the loan where had a longer time horizon, or are you confident when that loan comes due that you guys are going to be able to then refinance out like the back end
Sure.
of it?
And I follow. I mean, given the equity check on this, we did this ourselves. I mean, there wasn't any
Yeah.
need to raise money here.
Yeah.
But as far as the way the debt was structured and what gave us the comfort to kind of take on this heavy of a load was, I mean, we were borrowing at 5%. It's an interest-only loan fixed for 7 years. So
You're a magician, dude. That's crazy. That is crazy.
God, I'll say lucky in terms of being able,
Jeez.
having the lender.
Can you find me one of those, Danny? I'll invest with you
Yeah.
right now, dude. Holy crap.
And we've done some other deals with the lender, and they're fantastic, right? In terms of, they're committed to their mission of impact investing, of creating affordable housing, and working with operators who look, there's nothing wrong with making money, but they want to ensure that they're aligned with guys who care about the communities that they're investing in, and can deliver a product that not that they would just be proud of, but where the people live. They want, they want the residents to be happy. They want them to have a sense of pride, of ownership, when
Yeah.
they come back to their units, right? So that's a big thing for them. And there's not that there's like specific requirements, but that is something several times a year that we're talking to them and showing them all the things that we're doing for the residents. That it's not just like, oh yeah, look, we fixed this toilet when they had an issue, right? But resident events, offering them different incentives. I mean, look, now credit reporting is a requirement, but before it was a requirement, we were offering that to them for free and eating the cost,
Got it.
right?
So you're doing right by these tenants. You're not in this just for the smash and grab money play. Even if you could effectively make something like that occur, because you're in this for the long term, right? And
Sure.
we talked about this, and I've known this about you too, is you want the tenants to have an experience that is not one of how should we say, like slumlord, like, because
Sure.
when you're in the affordable housing space,
Yeah.
there's a stigma around having this kind of like, the cheapest renovations, the least amount of money that you got to put into it because you're trying to maximize what your income, the cash flow you're getting from it. But you've clearly taken a different approach to that, which seems like people who are willing to invest in a company like that and provide money for you to go and execute a business plan, like, they appreciate that. And so that is the approach that you've taken, and it seems to have served you very well.
Yes. Look, there's a bunch of there's a lot of affordable developers out there that are fantastic operators, and we pull from different playbooks to look to incorporate into ours. Not everybody's there to just like skimp on
Sure.
repairs, but yes, I mean, when you have this kind of built-in ceiling on rents, you do have to be careful with how every dollar's spent.
Mm-hmm.
If you're looking at a market rate project, you go increase $25, increase your rent by $25 a month, and that can capture kind of whatever cost overrun you had on a unit turn. affordable housing, you're definitely kind of limited, or just there. You just have to be a degree more mindful of how your dollars are getting spent. But ultimately, um, I think residents and staff feel that feel when you care about the property, right? Which is, I mean, largely thrown by how much you invest back into it.
Yeah.
Um, but there's there is an ROI on that, right? It's a much harder to quantify,
Uh-huh.
than like, okay, if I spend $10, I'll get $2 more in rent. It's like, okay, fine. You very, very
Yeah.
clearly can calculate that out. But there's no question, I would say qualitatively that, we see when you have higher resident satisfaction and employee satisfaction, like things run better,
Mm-hmm.
right? Like collections are better, vacancies are down. When a tenant leaves, like the unit is in better condition,
Mm-hmm.
right? So I would venture to say that, the employees and the residents reflect how the property owner treats their property, right? If they care, like typically, and it's not like this is not just covers. It's not a blanket statement that every tenant's going to care, or every
Sure.
employee's going to care, but they feel it, and the bad apples, they eventually, like, look, I say we're compassionate, but we're very strict about ensuring that rules are followed,
Yeah.
right? It's important because it doesn't take a lot for a building to go sideways with just a few bad tenants,
Mm.
right? So we'll give you a shot at trying to rectify whatever situation may have arose, but once you've after that, like, you're out.
Yeah.
It's just we don't have time for people who, like, who don't appreciate good residents and management
You run it
company
like a
quality.
business, man. You run it like a business. You want the
So
business to be running smoothly, and the tenants are a part of that business. And so, if someone is, squeaky wheel, you gotta fix that
yeah,
squeaky
no
wheel.
question.
Another crazy thing that we talked about before is kind of some of the ways that you've figured out incentives. And one of the things that I want to talk about is this office contest for $5,000. Like, what you told me about this, and I'm like, oh my gosh, that's so genius. What's the story behind the $5,000 office contest, and why did you do it?
Um, so this was like height of pandemic. We're uh we're building out units, and our distributor for our electrical equipment just could not get us our equipment. I mean, they delayed us. I mean, we ultimately still never even bought from them, but I mean, we were delayed like 2 years. Like, we are already now ready to go to install all of the switch gear, and they basically told us we have absolutely no clue when the equipment's going to arrive. Siemens is just like all backed up. It's a disaster. So I went into the office and I went to the employees and basically said, whoever can find the switch gear, gave them like the full equipment list.
Hmm.
Um, in the next 72 hours, they'll get paid $5,000. And within, I think it was like 24 hours, three guys came back and they're like, we found it all. They sourced it from like 4 or 5 different suppliers around the US, got everything, and basically the project was able to move forward. But I mean,
I love that.
any developer will know that the biggest um, killer of all deals is time
Mm.
when you're building. Like, it is it's a mad dash to the finish line, right? I mean, timing. I mean, we see now, right? Timing is so critical
Yeah.
when you're developing,
Yeah.
right? You get caught in the wrong part of the cycle, like, it's the difference between a project being successful or being, going bankrupt.
Yeah.
So, that was just one of those things that, I mean, we can easily underwrite the $5,000 as a cost of the deal.
Yeah.
Um, but it was, I mean, looking back on it, I would have paid a lot more, but I
Right.
mean,
That creativity. I mean, that's what you need. Like, when you're an operator and you're up against situations that sometimes feel like they're out of your control, I mean, this is a clearly a proven thing where maybe they're not as out of control as you think.
Sure. It's
And
look,
you can get creative with it.
there's probably generally like a solution to every issue.
Yeah.
In real estate. Um,
Have you always been creative like that? Like,
uh, maybe. I mean, you just when your back's up against the wall, you just it can really unlock a lot of just every idea becomes a good idea at that
yeah,
point.
yeah,
And
whatever we can do.
whether it's creativity or desperation,
Mm-hmm.
right? You're just like, I need this done, right?
Mm-hmm.
And you just start throwing out any idea. I mean, I don't know whatever other ridiculous idea I had behind that one, but I'm sure I had like a list of 20 other things. Like, if, okay, this fails, like now what?
Yeah, then
Right.
what we would
Right.
do.
Luckily, but it did teach me a very good lesson about incentives, right?
Mhm.
With the right incentives, um, things get done.
My favorite Warren Buffett quote, or maybe it's Charlie Munger, excuse me. My favorite Charlie Munger quote is, if you want ants to come, put sugar on the floor. And basically, it's like with the right incentives, which is bringing me back to this point of housing in Los Angeles. And it really, really does bug me because clearly the incentives are not aligned with the way that people say that they want housing, they want affordable housing. Clearly you went to North Carolina and maybe they're being more incentivized to do that, but they're disincentivizing investors, developers, people like yourself wanting to invest money, provide housing, improve the units, build units because the incentives aren't there. There's genuinely so much risk associated with being a part of the city at this point in time that it doesn't make sense when there's better opportunities somewhere else, and that frustrates me a lot. But are you still buying or looking for opportunities in Los Angeles? Like,
Yeah.
is that still a market that you want to invest in?
I mean, we just closed on a ground up deal, I mean, which is
Ground up, as in you're going to build it?
yeah, end of yeah.
Congratulations.
So we're gonna 69 units in Granada Hills.
Not 70, it had to be 69.
For a very specific reason. We told the architect, no, not
No,
70.
69 units has to be that.
Um, yeah, I mean, one, just taking a step back to kind of what LA is doing. I mean, ironically, everything that the city's doing is making housing more and more costly, and making existing buildings more valuable. Or, I mean, they're just creating so many barriers to entry for developers to come in and build that everything that does get built is just going to continue to go up in value. And then, just with all the red tape that's involved, which, I mean, the city now is trying a number of different initiatives like the ED1 and some other streamlined processes to kind of help push things along. But it's still like, instead of moving Mount Everest, like, you're moving a smaller mountain, like still moving a mountain
Yeah.
to get these projects done. Um, so
So you believe in Los Angeles?
I mean, yes, right. I mean, we're still we're still pretty heavily invested here.
Yeah.
Um, I think fundamentally, right? I mean, unless you think Los Angeles is gonna start to lose just massive amounts of people, like, it's so dense. There's still a lot happening here. It's one of the largest economies in the world. Like, I mean, God forbid, like, we'd have to have a lot of wildfires and a crap ton of earthquakes that are just gonna, like, completely make LA utterly uninvestable, and you just like, we can't even live here anymore.
Yeah.
Right? But there's still a lot of, I mean, LA's like so dynamic in terms of the employment base, the demographics of people. Um, there's a lot happening here that um you still have a lot of capital, even though maybe a lot of institutional capital has fled. Still a lot of money here, right? It's a super liquid market. So, I think what we're seeing is definitely a thinning out of buyers and competitors, which we're happy about.
Mm-hmm.
Um, and I mean, if you look back on Los Angeles, like the greater LA area, I mean, we've been through a lot, and somehow we keep on managed to grow and things just, continue to move forward and values have gone up, over time. Yeah, you may get the blips up and down throughout the years, but largely speaking, it's kind of, the upward trending graph that, so long as you can kind of work your way through these tougher points, you should hopefully get to a place where, you'll see that return.
Where are you looking for opportunities? So what are the LA opportunities that you would like to invest in and buy?
I mean, we just closed on this ground up deal in Granada Hills. Um, we invested in a portfolio of housing units in South LA last year. We did a we did a business loan. We kind of
Yeah, yes,
made
yeah.
that.
Yeah, tell me about that.
So yeah, this kind of just speaks to I don't know, the enterprising Jew in me. That son, as long as there's like money to be made, we're kind of gonna look at it. I got approached to invest in a business. We couldn't invest equity into the business for a number of reasons. So instead, we decided to give the money as a business loan, but the operator had a fairly substantial real estate portfolio. So went to him and was like, let me look at the portfolio, because if I can get comfortable with the real estate as collateral, then like I'll give you a business loan. 'Cause as far as I'm concerned, like I'm basically just invest. I'm looking at your real estate as really the collateral. So we were able to get comfortable with it, and we gave the operator um, his loan, basically go build out the business, and so that was uh, kind of far away from
Yeah.
what we do, but also still within like the sandbox of where we play, which ultimately I looked at the business. I think the business was super interesting, but it was still the underlying collateral was real estate.
Yeah.
There's that. But as far as what we're looking at, I mean, we put out an offer on. We're seeing a lot of non-rent control, non-RSO stuff coming up in LA now, um, which I think has some compelling metrics to them that we'll see where they shake out. I mean, obviously, it hasn't helped that rates have kind of blown out over the last couple weeks here. It's definitely put a wrinkle on getting deals done. But again, if you can,
If there's money to be made, Danny will
sure.
play ball. You will play ball, right?
Yeah, no,
Because
for sure.
you'll do any. I mean, you'll do the value add. You'll do the Section A stuff. You'll do a business loan. You'll do ground up development. Like you have a specialization in finding ways to make lemonade out of lemons. It feels like, and at least seeing a way to have that
Sure.
be the case, right? And in a sense, all wrapped around real estate, where there's that comfortability.
Housing, right? That's kind of what I would say the common thread between all of it is ultimately the underlying um, commonalities that it's underpinned by apartments. I mean, can we look at have I looked at office and all that? Like, yeah, back in the day, we invested at the last company I was with. We literally touched on every asset class and looked at all different parts of the capital stack, and we're just super opportunistic with how we approach. So there's a lot of that lens through which I look at opportunities that I brought from that company here, where it's like, okay, look, yeah, if there's something interesting here, and I would say that's largely just for LA, right? I'm not looking at anything else other than really value add multifamily when I go outside of the greater LA area. But kind of Los Angeles being my backyard, and really I kind of know every market more or less that where we would invest. It lends itself to being a little bit more broad ranging as far as what I would look at. But I still kind of stick with our core competency of just looking at multifamily value add, ground up. And then, whether that's market rate or affordable, it's just a function of that's just underwriting and just kind of placing the deal into the appropriate bucket where we can extract most value from.
Yeah, and make everything make sense for you, your investors. And so I'm curious to know, what does the next 5-10 years look like for Cage Equities for you guys? Like in a perfect world, right? Magic wand, our plan and what we're trying to do, what does that look like for you?
Blackstone move over.
Schwartzman, get out of the way. John Gray,
Yeah.
you and your running LinkedIn videos, which I'm a fan of, by the way. John, you're welcome to come on the podcast
Tell him,
and speak.
yeah, we're taking resumes, so whatever you want to submit.
But you guys obviously want to continue to grow it and grow in the housing space, and just kind of keep doing what you're doing.
Yeah, I mean, I would love to, we're, like I said, around 300 something million today. Definitely want to grow. We're looking to grow our investor base to, have more institutions.
You're taking more
involved.
investors.
Yeah. I'd love to double our AUM this year.
To 600 million.
Yeah. I would say
Let's
within
go.
the next 3 to 5 years, hopefully be at about $1 billion of AUM, right around there.
And you'll be my friend, man. That'll be
Yeah, right?
sick, dude. I love it.
Much of that's I'm gonna own is another story. We're gonna be levered up 99%.
Yeah, hey, look,
The $1 of equity invested in that billion.
$1 billion corporation right there, man. That's what matters.
So yeah, we're just looking at $1 billion enterprise value. How that's comprised between
Yeah,
is completely irrelevant.
we don't need to worry about that.
But that's that's the aim there. I mean, look, we're a super lean team.
How many people?
6 of us.
Oh, geez. Yeah. So you guys run real efficient.
Yeah. Maybe too efficient if you ask the employees, but I mean, it's look, right now has been a very challenging environment overall, right?
Yeah.
We're getting squeezed on every line item imaginable. Rents, largely rents have been holding up, but nonetheless, right? It is a tougher environment. So yeah, you got to get more bang for your buck on everything you do, and all the resources you're investing in, you just need to see a greater return on them. Whereas back in the day, just like money was free. I was like, oh, who gives a damn? Like,
Yeah,
we're gonna make money, just hire whomever we want, pay a person whatever they ask, and call it a day. Because this buyer's gonna pay me a 2 cap for my real estate. Like, let's just try to get as much of this going as we can. Now it's a completely different market, and a lot of big operators that I've been talking with, I mean, they are tightening their belts substantially.
They got to get creative.
You got to get creative, and it's just an all hands on deck approach, and you've really got to scrutinize every line item. I mean, I'm not gonna say that they didn't do that. I mean, we've always done that, right? I mean, we're constantly looking to maximize.
You're a freak in the sheets, man. You're a freak in the sheets.
Sure. I'll take that.
Yeah, it's good. It's important. And some of the best, I study entrepreneurs and successful business people, and they're always to the penny. They know where things inefficiencies are and how they can lower the cost as much, even if it's by a penny. So you clearly have done that. I know as the lean team you have a call coming up.
Yeah.
Is that correct?
Yeah, it's running already late.
Okay. Well, hey, Danny, I want to let you get back to your call, run your team. This was incredible.
This is awesome.
Thank you very much for coming on here, dude.
This is awesome.
Let's go.